Okay, now I'm not muted. Very good. Okay, let's try that again. So, welcome. The goal tonight is to talk to you about what's going on in markets, and I think many people have been very upset, traumatized even by the fall that we've seen over the last 2-3 weeks. And I think many people, when they see this kind of market sell-off, react irrationally. And hopefully, by talking you through what's going on, in my opinion, and where we might be headed, and what may be some things to think about in terms of what to do about it, this will calm you down and make you avoid doing those irrational things, which could hurt your wealth longer term. So that's the plan. We're going to talk through what's happening in markets, some of the economics behind what's going on, plus I think some home truths about how you should react to it. And at the end, you can ask some questions, and that's the plan. And the plan is also not to be muted when I start a live stream. I'm sorry about that. So let's just start off with what's going on in markets. So at the moment, obviously, we have seen a bit of a sell-off. We've seen a 10% sell-off. And what is unusual about this over the last 2 years is we're not used to it. We're not used to markets which fall. We're just used to markets which, with brief pauses, tend to go up very rapidly, primarily about the US, primarily about growth stocks, primarily about the Magnificent Seven. And of course, those are the stocks which have let us down over the last 3 weeks. So what is going on and why? So let's start off by just focusing on the stock market, because I think that's where most of people's wealth resides, but also where the greatest returns are longer term. So let's have a quick look across different markets just to see what the returns have been. And what I've done is I've actually looked at returns since Trump's inauguration, so end of January. Now what you can see here is a very clear split across the world. Blue bars show you the returns which are positive, red is returns which are negative. And the big negative bar, the largest, is the Nasdaq 100. Now, of course, that's been the success story over the last decade, the outstanding success story about growth, tech, and the US and US exceptionalism. And yet, that's exactly what's gone into reverse, because, of course, the epicenter of the current economic problems, potentially, is the United States. The S&P 500 down 6.6%, the Nasdaq down 8.6%. And of course, Japan also down about 5. India, which was horrendously overvalued, more overvalued than the US going into this sell-off, that's also fallen by about 5 so far. The FTSE 250, the mid-cap index for the UK, down about 4. And if you buy a global index, it's down by about 4 to 6%, depending on which flavour of global you've got. And then if we look at the positive returns, China up about 20% almost. Europe storming upwards at 8%, and we'll talk about that more in a moment, with Germany up about 8, Swiss stock index, the SMI up about just under 7, and of course the CAC 40, the CAC 40 index up about 3. So very clear divergence there between Europe, which was seen as the kind of no-hoper. Previously, when I was talking to single clients about why they might want to diversify away from the US, it sounded ridiculous to say that Europe might outperform, because people just said, well, why would Europe outperform? Which sector is going to outperform? But in fact, that's exactly what we've seen. Banks in Europe, but also defence stocks, of course, for reasons that we'll talk about in a minute, are the ones which have outperformed. So that's the kind of broad picture since the election. If we go back to the inauguration itself, so that's the vertical line you can see here, and we look at the MSCI World Index excluding the USA, so this is developed market ex-USA, of which actually I think the UK is the biggest component, and then the MSCI USA Index, you can see that the end to exceptionalism, at least for now, was clearly demarked by Trump's inauguration date. So far at least, it seems as if markets initially weren't too worried about all the talk of tariffs, the slew of executive orders, the on-off nature of the tariffs, until those tariffs were imposed in size, those 20% tariffs on Mexico and Canada, allies of the United States. And then, of course, we have the counter tariffs from China, Mexico, and Canada. And then suddenly markets came to the conclusion that actually this could be a problem. And we've seen some very sharp readjustments in equity markets since then. Now, it's still the case, if you compare the forward price to earnings multiple for Europe, so that's this red line here, it's still considerably cheaper than the US. Even after this big sell-off, there's still a huge divergence in valuation between the US, which is still at over a 20 times forward multiple. You're paying $20 for every forecast dollar of profit for the United States. So it's not the case that the US is anywhere near cheap yet. Remember, the average, long-term average of forward price to earnings multiple for the US is about 16 times forward earnings. If you compare that with Europe, it's still hugely overpriced, I think. So I think this has got a lot further to run, depending on whether Trump carries on with the current set of policies or whether he backpedals. Now let's turn to currencies. Now what's good about currencies is they price in macroeconomic data very rapidly. So you get to see what markets think about growth prospects very quickly usually. And what's pretty clear is the devaluation of the dollar has been very abrupt and quite shocking, in fact. So sterling versus the dollar up by about 5%, the euro's up about 4.5%. If you compare the dollar to the Swiss franc's strengthened by about 3%, and dollar yen, the yen is strengthened by about 4.5%. So overall, except for the Aussie dollar, of course, that's one exception, we've seen a very marked weakening of the dollar. And what was also interesting is during one of these large sell-off days is normally you'd expect to see that the dollar would be the safe haven currency. But in fact, what we've seen recently is the dollar no longer acting like a safe haven, which is absolutely shocking. I've never seen that before, except in really awful crises like debt ceiling crises, which really went to the wire. So that is very worrying and suggests that investor sentiment towards what's going on in the United States in terms of macroeconomics I best characterize it as a state of disbelief. Now let's turn to commodities, because obviously these are another measure of what markets think is happening to growth. Because, for example, if copper does well, that suggests that maybe economic growth expectations aren't particularly bad. So, of course, it's China which primarily buys copper. They buy most of the newly mined ore. And it's interesting that copper's up by around 11% since the inauguration. Which is interesting. Gold also up because there's a lot of fear and uncertainty in the markets. Plus, there's a really nice arbitrage trade where gold is selling for more in New York than it is in the UK. So a lot of gold's been shipped via Switzerland over to the United States. Oh, and I should also mention while we're here, let me just quickly flip to this. A lot of this stuff I've discussed recently with my genius co-host on Many Happy Returns, Michael Pugh. So the latest edition of our podcast was The New World Disorder, Investing Amid the Chaos, where we talked about various aspects of the US economy, the sell-off and what we should do about it, but also what's happening in geopolitics. And as usual, Michael and I injected a bit of humour into it. You have to, really, don't you, when you've got awful situations like this in order to cope with it. But I definitely recommend that if you're interested in learning more about what's going on. Also interesting is, I've included it as a commodity here. Of course, it's not a commodity. Is the price of Bitcoin, which has tanked since the risky asset sell-off, because it is a very risky asset. It's not a store of value. It's like a leveraged version of the NASDAQ. So Bitcoin is down by about 18% since the inauguration. Now, if you actually look at 3 times the daily NASDAQ return and look at the cumulative 3 times NASDAQ daily return, that's the yellow line that you can see here, and compare that with Bitcoin, which is the red line, the two track each other pretty closely. In fact, during this big sell-off, the two have reacted pretty similarly. There was a big boost in Bitcoin just before the sell-off due to the stories about the reserve, the Bitcoin reserve or the cryptocurrency reserve that the United States was going to create and is still planning to create, it has to be said. But that hasn't, that kind of boost in the Bitcoin price hasn't survived the huge risk-off move that we've seen recently. So in case you were in two minds about whether Bitcoin is a safe store of value or whether it's just a leveraged version of NASDAQ, well, there's your answer. I think also it's interesting to look at bonds, because you can actually look at what bonds are pricing in terms of growth and inflation to see what markets think is going to happen. Now, this isn't perfect, it's far from perfect, but if you look at the real yield on US 10-year government bonds, or the break-even rate of inflation priced into US government bonds, you can back out the expectations about inflation or growth. Now, what's interesting that the inflation expectation, which is what you get from break-even inflation, hasn't really fallen much at all. Whereas the growth proxy, which is real yield, that has fallen significantly. So it seems as if markets have kind of knocked over 0.2 percentage points off US growth in terms of what they expect is going to happen in the near future. So I think that's pretty worrying, that bond markets, just don't buy into this set of policies that Trump's come up with, and his advisors, of course, in order to increase US growth, which is worrying, right, for the Trump administration as well. If we look at the fixed income space, and instead of looking at government bonds, we look at corporate bonds, until recently, whenever I looked at the spreads on corporate bonds, they were just super tight. They weren't pricing in much risk of a default at all. But that's changed very quickly. As equity markets sold off, this is often the case, the credit spreads have widened. So they're pricing in a much higher default risk now than they were previously. And that is worrying also, because that suggests that if default rates are picking up, it's because debt servicing will become more difficult if growth slows down. And it all kind of fits into this narrative of slower growth due to tariffs, maybe higher inflation, more restrictive monetary policy, and generally a bad outlook. So now let's turn to the US economy, and we're almost there. This is the end of my spiel, and then you can ask some questions. It's certainly true that going into this presidency, we actually had, if I had to characterize it, we had a huge spike in inflation following the pandemic, which then gradually came under control. It subsided, perhaps because of the action of central banks, perhaps because the shock simply subsided. But whatever the reasons, inflation was coming back down to the 2% target for the Fed, and growth was pretty strong for the United States. Now, for a developed market, you might expect growth rates of maybe 2.5% real growth. So the US, if anything, was growing above trend. We got a weak Q4 2024 print. So, of course, that was the last full quarter of President Biden's presidency. But overall, this looks like above trend growth to me. So really all that people wanted, I think, economically from Trump was to get inflation back down, maybe even below that 2% rate, and not break growth. I think that was basically what people wanted. Maybe more a kind of resurgence of US manufacturing, so that it wasn't just rich tech people on the West Coast that were benefiting from the economy, who would be spread through Main Street throughout the whole of America. Maybe that's what they wanted. That would just be my way of characterizing it. But what we've actually seen in terms of policy is a narrative whereby the current regime, the current administration, wants to break the economy in order to improve wealth further down the road. That seems to be the narrative at the moment. And frankly, I don't think the US electorate wants that. They don't want to have a period of suffering, higher unemployment, higher inflation, lower growth, in order to get to those potential targets of higher, longer term growth and a resurgent manufacturing base in the United States. I think there won't be appetite for that. And we are starting to see the popularity of Trump's policies start to wane very quickly as people start to see the effects of some of these policies. But at least that's my take on where we were, what the electorate wanted. If we actually, of course, we're only 7 weeks into this presidency, so it's too early to see what the effects are on GDP because it hasn't been really affected yet. What we can do is look at forecasts from economists at Goldman Sachs, Morgan Stanley, and what's happened recently is that Goldman has cut its 2025 GDP forecast by 0.5 percentage point, which doesn't sound like much, but given that previously it was 2.2%, and now it's 1.7%, that's pretty shocking. Now, the reasons for that, the mechanism, the kind of transmission mechanisms from policy to growth, the weakening of growth, were firstly that tariffs would reduce real disposable income in US households. Secondly, that this would reduce consumer spending, and often this goes with tighter monetary policy because they're also forecasting higher inflation. And then thirdly, that businesses, due to uncertainty, business uncertainty, would be discouraged from investing. All of those have a negative impact on growth, according to Goldman Sachs. And if you listen to Jan Hatzius, who's the chief economist at Goldman, he said the reason for the downgrade is that our trade policy assumptions have become considerably more adverse. So the average tariff that they expected on US imports was about 5%. They've now upgraded that to about 10% because of the huge tariffs on Mexico and Canada, but also now on the EU, with more appearing and disappearing every day, of course. And then Morgan Stanley also have downgraded their growth forecast for 2025 down to 1.5% from 1.9, so 0.4 percentage points for similar reasons. And they've also increased their inflation expectations. So all pretty worrying stuff, I think, for the current administration. And if we look at something which is nothing to do with analysts at banks, which is to look at Polymarket, which is a betting market, and look at the probability of a US recession in 2025, you can see that that's shot up recently to about 40%. Previously, it was about 20%. So it's not just economists at investment banks. It's also this kind of betting market, which represents the opinion of many people, and where people are betting real money based on their opinion about what's going to happen. So I think I'd characterize this kind of the state that we're in now as, yes, we're starting to see a weakening of economic data. What's definitely true is we've seen huge uncertainty enter market. If you look at the manufacturing, the PMI report from the United States for manufacturing, and read what individual companies were saying, they're all talking about uncertainty. That's in every single statement. And of course, if you're uncertain, you don't spend because you don't know what's going to happen to your margins, you can't plan. And so this has been hugely disruptive for US companies, and it's had a chilling effect on growth and orders. And if that continues, I think it's going to have a really negative effect on growth. So that's my worry. Now, I think what might happen is once it becomes much clearer that there is a weakening of growth, if that does happen, and markets continue to tank, I think the administration will probably start to step back on some of its policies, the really radical stuff, and also maybe stop saying crazy stuff like Canada should be the 51st state. I mean, that just makes the US look ridiculous, and it's not going to happen. It's just going to offend Canadians. So yeah, I think that's a likely outcome, which is Trump will have to say, oh, I've achieved what I wanted to, to save face, and then dial down some of the tariffs that and some of the policies that he's talking about right now. If that doesn't happen, I think we'll continue to see the uncertainty, the weakening growth, and we'll continue to see the sell-off in equities. So now let me just finish, before you ask questions, with how I think you should react to this. So some home truths, right? So markets are down 10%, global equity markets. If that's making you think, I'm going to sell, then that immediately tells me that you shouldn't have had so much equity in the first place. I always say to people, imagine a 30% sell-off, then think, well, what portfolio would have made me comfortable with that loss, without feeling like I needed to sell? But what I always find is that after a sell-off, that's when people come to me and say, look, I sold, I said I wouldn't, but I did. And so I know that they had too much equity. So if anything, come out of this with a better understanding of your risk appetite. You know, if the 10% sell-off has you freaked out, then clearly you've got far too much equity in your portfolio. De-risk slightly for the next round, but whatever you do, don't sell during an equity market sell-off, because you have to choose 2 points. Your exit point, so that's when you sell, and then you have to choose a point at which to get back in. And it's very scary to buy equity during one of these periods of volatility. And you have to time both of those right in order to do better than you would have if you'd have just held on. And that's why most of the time it's best simply to hold on. And if you are saving, carry on saving. There's only one exception to that, which is if you do have a lump sum to invest, a lump sum of cash, maybe you've inherited it, maybe you've sold a business, then yeah, think about drip feeding into the market. If that's what it takes to make you invest, then during these periods of volatility, you could get a better average price if you drip feed. But if you're just saving regularly because you're 20 years old and you're earning, you're saving your excess, carry on. And don't change your portfolio because of what's going on in markets, because it's very unlikely you'll time that correctly or call it correctly. Stick with your long-term plan, carry on saving as much as you can, and things will get better. They always get better. This presidency will end. Maybe the next presidency will be better. But whatever the reasons, things have always improved, because people are not willing to tolerate market unfriendly policies for a long period of time. That's one of the benefits of a democracy, which is that you can choose new leadership if you're not happy with the old ones. So things will get better. This will pass. It's not a very big sell-off anyway, 10% if it's global index. If you had a very concentrated position in growth tech stocks, yeah, potentially that's a problem. But I think a large majority of the people, certainly the ones which are listening tonight, probably didn't have that anyway. So that's it. That's my spiel, and I hope that was useful. And now I'll pass it on to questions via Teddy. I'll get Teddy to come upstairs for a quick schnack. And I do see that we've got some super chats. Yeah, so if you do have a question, do a super chat. I'll answer you your questions in order, and I'll answer the super chats first. Anyone who supports our channel on YouTube, I'll answer your questions first, and then we'll move on to other people if we have time. And here comes Teddy. He's just had his flea tablets. I managed to give him some duck pate, and I crushed his flea tablets into that, so he doesn't know it. But he's now a very hostile environment if you're a flea. Aren't you, Ted? You're going to stand up, or are you just going to stand on my leg? That is cheating, you realise that? Oh, beautiful standing. Well done. You're going to go back down to Laura. She's got some biltong downstairs. South African biltong, because we were in Cape Town recently. You're going to go and get some biltong. I think Laura might have eaten it all. You're going to go down? Oh, yeah. That's biltong, Ted. Biltong. Go on, go on. Go, go, go. Very good. Right, so back to your questions. Yes, Laura says, tell people, subscribe to Many Happy Returns podcast, and you can get that on Spotify, Apple Podcasts, and do subscribe to that, because I think a lot of people find it helpful, because the message is essentially the ones that you hear from my channel all the time, which tends to calm people down, which at a time like this is quite helpful. But also there's this element of humour and Michael's intellect, which kind of boosts the programme, I think. Because Michael's so good. I mean, he came to Many Happy Returns without much knowledge of investing. He had invested for some time, but now he's learnt so much, and I think he adds so much to it, and particularly the humour. I think that really adds to the palatability of the podcast. But do listen to that. I think you might find it interesting. Right, so the first question is a super chat, thank you, from Amir Ketobchi, who says, hi Roman, fingers crossed. Here's hoping Trump's idiocy continues until 6th of April so I can buy some index funds in my ISA at a discount. Keep up the good work. Look, that's a great point, which is if you are investing and you're young or not so young, if you're still buying, you want to buy at a discount. Why wouldn't you want a sale? If you liked global index funds at £80 a share, will you like them even more at £70 a share? So it's not as if that's going to negatively impact future returns. It won't. It'll actually boost future returns because markets always recover. So that's the way to think of it. A sale, not a crash. That's the way to frame it mentally. And if there are things you've been keeping an eye on, I keep a market crash shopping list, and high yield credit is on my market crash shopping list. And as I've watched the spreads widen, I've been slowly salivating. That's another sale. So look for these disruptions. Look for things which are now attractive, which previously were very expensive. Maybe it's Nvidia, maybe it's Tesla. If you buy into the Tesla story about robotics, self-driving cars, the taxi service that it could create globally, cars as a service, whatever you think of it, you can now buy that at a huge discount to where it was. It's still quite expensive. It's still at about 70 times forward earnings, but it's cheaper than it was. So yeah, it's a discount. So yeah, hopefully we will see this sell-off get even worse, because unless you're someone that actually is drawing on the funds themselves in retirement, this is good for you. You're buying at a discount if you are still buying. Next question. Thank you, Amir. The next question is from Matthew Dick, who's also super chat. Thank you, Matthew. He says, guilty confession. I put in downside protection on my core ETF, VHVG. Got stopped out. Oh no. Got stopped out today. No losses. How would you handle getting back in? Okay, well, this is the problem, right? Which is, if you did have a stop loss on your VHVG, you're now in cash, and who's to say that we won't get some kind of stepping back of tariffs now, and there won't be a huge surge upwards in markets as a result, and you'll be left locked out of the market in cash. That's the risk. How would I handle getting back in? Well, effectively now you're drip feeding, right? So if you are nervous, drip feed back in. And that way, if there are falls in the market, you'll buy at a lower average price. But really importantly, you'll get back on the wagon, which is the important thing. Get back to where you want to be. And certainly consider whether you should have less equity in your portfolio. Because the fact that you had a stop loss on your core holding of equity tells me that you probably don't have enough risk appetite to have the amount of equity which you had previously. I'd say it's better to just dial down the risk in your strategic long-term weights and just live with that long-term portfolio and the consequences, which is usually slightly lower return. Not hugely lower, but a bit lower. If it's say 60-40, 70-30, whatever, equity bonds, equity money markets, whatever you choose. But that's how I'd handle getting back in, which is to drip feed back in. Because effectively what you've got is a large amount of cash now. I think that's probably how I'd do it. But look, also Matthew, I'd say learn from the experience. Learn about your own behaviour. learn about your own risk appetite, and plan for the next one. That's the whole point of each of these. They should be a learning experience, and it should allow you to fine-tune your reaction to these inevitable market pullbacks. There will always be pullbacks, so you've just got to learn to live with it, and also learn how to cope with it in your own way, because everyone's different in terms of their risk appetite. So you've just got to find what works for you. Next question is from Mr. Hanlon, also a super chat. Thank you, Mr. Hanlon. He says, "Hi Roman, sorry maybe you've covered this already. The sell-off in equities doesn't seem to be mirrored in copper prices. Thoughts?" Yeah, I mean, I'm quite sensitive to the copper price because for some time now I've had a copper miner portfolio which isn't doing particularly well. The reason why I bought it in my fund portfolio was because it was the usual thesis, right, which is that we're moving towards renewable energy globally, and that's going to be very copper intensive. With EVs, they require a lot of copper. Offshore wind also requires a lot of copper. There are finite mines. It takes a long time to build the mines. Limited supply, increasing demand pushes up the price. But as always, with all these great investment theses, it didn't do particularly well. Partly because China was doing so badly economically. I think it was largely because of that, actually. But we have seen them get back up. But look, if you look at what's happened to Chinese equity prices, you'll notice those have also improved. So I think a lot of the narrative that we're hearing at the moment is that China's a basket case, it can't grow, it's got this huge debt overhang, that it's politically a dictatorship. You only hear negative things about China. But I think actually, as long as China doesn't steer that course that Russia did, which it might do now, given what's happened with Russia, but as long as it doesn't steer that path, and as long as it keeps one toe in the water with diplomatic relations with the West, then I think there's a lot of upside for China. The reason why I keep away from investing in China is because I think it may take the wrong route, and it's a binary outcome. And if it does, then you could be facing frozen assets. You just won't be able to get your money out, which is what happened in Russia, of course. But I think that it's largely what's happening in copper is because what's happening to the Chinese economy, which is not its growth is not as bad as people were thinking it was going to be. And I think the impact of tariffs will be fairly negligible, the direct effects, because the actual exports to the US are fairly small. It's spent the time since the previous Trump presidency building better trading relationships with other countries, local countries, closer to China. And so it's less dependent on exports to the US. It's more dependent on people in China consuming. So that's the big thing at the moment. So the question is, will they be able to move towards a more consumption-driven economy within China? But it's certainly looking as if the actual price of copper is a proxy for Chinese growth anyway. So I take this as a sign that Chinese growth is actually better than we expected. Next question is from Monkey Do, also super chat. Thank you very much, Monkey Do, Monkey Doe. Not sure. Any thoughts on A, what speed to drip feed a lump sum? B, where to? C, where to keep cash in the meantime? Keep up the good work. Yes, I have ideas on all three of those. Now the speed, I did a 2-year lit drip feed. When was it? It was 2021, I think. 2021, 2022. So I caught the tail end of the tech wreck, or the beginning of the tech wreck, in fact, towards the end of the drip feed. But 2 years is excessive. Most people say 12 months because stocks drift upwards most of the time. Even when there's really bad economic news, eventually there's a recovery, sometimes much more quickly than you'd expect, as in 2020, for example. So yeah, most people say a 12-month drip feed is enough. If you're feeling really cautious and you're a masochist, yeah, 12, maybe 2 years, but that's excessive. because most of the time, 2/3 of the time, you're better off lump sum investing. And now that valuations are lower, of course, the downside is also smaller because fundamentals are more likely to be supportive. So I think, yeah, I'd certainly think about drip feeding over a 12-month period now. Where to drip feed? Well, you've got to find that long-term asset allocation you're comfortable with, the one you're going to stick with. So clearly this will calibrate your risk appetite knowledge, self-knowledge. If this 10% sell-off in global equity has got you spooked, well, that tells me you've got a very, very low risk appetite. You know, you shouldn't even blink at 10%. 20% is painful, 30% is awful, 40% is potentially what could happen. So, you know, equity comes with that as a feature. It's not a bug, it's a feature, and it allows you to buy at lower prices. So I think where to depends on your risk appetite, your investment horizon, and your risk capacity. How much of a loss can you weather economically? And once you factor all of those in, you know, risk, the investment period is also really important. 5 years or less, hardly any of that money. If you need the money in 5 years or less, don't put it into equity because it's very volatile. If you're not going to touch the money for 10 years or more, then a lot of it, I suspect, should be in equity unless you have a very low risk appetite. So all of these things factor in. How long will this sum of money be invested? What's your risk appetite? That's your psychological capacity for loss. What's your risk capacity? What's your economic capacity for loss? Will it mean you have to cut back on your expenditure if equity markets fall, if you're in retirement and you're drawing down on the pot? All of those things factor in, which is why there's never a single answer to part B of your question. And then part C, where to keep the cash in the meantime, probably a money market fund. So if we look at the SONIA rate right now, and we have to do this in an incognito tab in our browser because the Bank of England's broken. SONIA rate, Bank of England. Let me just show you what I'm doing. SONIA rate, Bank of England. There we go. And here it is. And we're going to zoom down to the graph. I think it's 4.45 at the moment from memory. It takes a while usually to appear. But this is roughly what a money market fund will give you, SONIA. So this is for UK money market funds, I should have said. I assume you're in the UK, maybe you're not. But if you look in the United States, you look at the SOFR rate, the SOFR rate. Come on, Bank of England. Here we go. So yeah, 4.45, call it 4.46. So that's the current rate of interest you'll get on your money market fund in the UK. So that's probably where I park it at the moment. And then if you look at the yield curve, so I'll just pull up the UK yield curve as of yesterday's close. Always compare that to see whether you'll get a better rate with single gilts. And I'll dashboard, trackers. So this is one of the things you get with PensionCraft. So I'll pull up our macroeconomic trackers. Whoops. And we'll pull up UK yield curve. So this is as of yesterday's close. So 4.45 is about here. So once you get to a maturity of about 7 years or more, you get a higher yield on your single UK gilts. So if you are going to go out further on the curve and hold a gilt to maturity, 7-8 years will get you a high yield, depending on the bond you choose. So that's where we are right now. So yeah, I think at the moment I'll probably stick with the money market fund because it's liquid. You don't have to tie up your money for any period of time, and the rate of return is very good, and the risk is very, very, very low. So that's probably where I park it in the interim. And then your last question, I think I've answered. Yes, there we are. Next question is from Gavin Lawrence, also a super chat. Thank you, Gavin. And Gavin says, any opinion on pound versus the dollar? Continued pound strength? Thanks. Well, yeah, I think at the moment what we'll probably see is continued uncertainty. I think FX is there to make. They always joke that FX strategists are there to make equity strategists look good, because it's really hard to call currency, even though it's driven by fairly well-known factors: growth, interest rate differentials, inflation maybe. But it is very difficult to call currency, even at times like this. So particularly at times like this, where there's huge trade uncertainty. But if tariffs on-off continue, if this crazy policy volatility carries on in the United States, then I'd expect the dollar to weaken further, and also growth expectations for the US to weaken relative to the rest of the world. And that usually erodes the value of the dollar. So that's what I'd expect. But if suddenly the decision is to water down the tariff policies, then things could reverse very quickly. So that's why I think it's really hard to call, because ultimately it's driven by the whims of essentially one guy, and that's almost impossible to call. So yeah, my expectation is that given the amount of investment already in saying that tariffs are great, that he's a tariff guy, tariff's the best word in the English language, given all of that, I think it's unlikely he's going to back down yet. There's going to have to be a lot more pain before he's forced to back off. So my expectation would be that that sterling would carry on strengthening versus the dollar. But would I bet any money on it? No. So just be aware of the fact that that's almost impossible to predict, Gavin. But that would be my guess. Next question, very generous super chat from Goodg, yeah, Goodg. I don't know how to pronounce that. Goodg. And they say, I know you don't brag about yourself, so using this opportunity to brag about you without you needing to do it, tell them you're a physicist. Oh, that's funny. Tell them you're a physicist and your academic credentials. Doing this just for that person. Yeah, there's a certain person who in the comments was saying, oh, you've been dining out for ages on the fact that you're a physicist. Who cares? It shows, that you're an idiot. Well, I hardly ever mention it. But now that Goo just said it, yeah, I've got a doctorate in physics. I've got a first-class degree in physics from Imperial. Yeah. Let's rub salt into that wound. I don't know why it upsets them that I mentioned it once. I'm really into physics. I still love physics. I still find it fascinating. It's probably why I'm a nerd and why I like reading science fiction. But look, yeah, I'm a physicist. That's why I use all these crazy graphs, right? Because physicists see the world in numbers. Next question is from Fabian Hatker. Thank you, another super chat. Fabian says, hi Roman, sounds like stagflation. Is it reasonable to try securing some capital with inflation-linked bonds? Is there an ETF? Interested. I mean, I can see the currency of your super chat is in euros, Fabian. Are you based in the Eurozone? The reason why I ask is because the situation in Europe is actually improving. We're seeing huge spending on defence. Many countries in Europe are now going to increase the amount of GDP which they spend on defence, and that's probably going to stimulate growth. And I mean, a lot of people have been joking that the MAGA movement is actually the Make Europe Great Again movement, MEGA, because if you look at the equity market in Europe, it's just been soaring upwards. Banks and defence companies, of course. In fact, in PensionCraft, they created their own pie for defence companies, which we've been sharing with one another on Trading 212. Is it stagflation though? In the US, I think it's very unlikely. We're still a long way off stagflation. Growth in the US is still pretty good. You know, more than 2 percentage points is what most banks are expecting. So Goldman's cut it to, what was it? Goldman's cut their forecast from 2.2 to 1.7 GDP growth in 2025. But that's still miles away from recession or even stagnation. So certainly in the US, I'd be amazed to see stagflation. And again, the inflation expectations are not huge, even though, you know, we've seen such widespread tariffs. Because, you know, if there's weaker demand, then that has a counteracting effect on inflation. And usually that's one of the consequences of tariffs, which is weaker demand. So, yeah, I think in the US, certainly stagflation is unlikely. In the UK, more likely. But even here, you know, growth is just teetering on being positive, so that's stag. The inflation bit, I'm not convinced we're going to get that. It really depends on whether we have counter tariffs. I mean, so far it seems as if we've kind of flown under the radar, not for aluminium tariffs, it has to be said. Those were imposed on us. Steel and aluminium applied to us as well as the Eurozone. But, you know, maybe we'll fly under the radar in terms of tariffs, so we won't have the inflation bit at least. You know, inflation's coming down and the Bank of England's going to be cutting rates. So, you know, I think it's unlikely we're going to get the inflation bit. The stag bit, unfortunately, in the UK we do have. But Europe, I think Europe's actually looking pretty good at the moment, if that is where you're based. And stagflation there is fairly unlikely because of the stimulus and the greater spending. And, you know, taking away the German debt brake is astonishing. I never thought I'd see that. But things have turned around very quickly. The policy response, to be fair to Europe, has been incredible, both for the energy imports, but also for the kind of 180-degree turnaround on defence. That's amazing, and I think a positive. So finally, one more question from LC, unless some others pop up. But one more super chat from LC. Thank you. Just a thanks for your podcasts. I'm not fretting about my reduced SIP and stocks ISA balances. Good for you. It'll come back up. You're right, it will. Even considering buying the dip. Marvellous. My work is done. So let's end it there. Do have a listen to our podcast. Many happy returns. Do subscribe to it. It's on Apple Podcasts and on Spotify. Here's Michael. He's the clever one and the beautiful one. I'm the ugly old one. Do subscribe to that. Do join our membership. It's just a very low price. And we've now got a portfolio planning tool. Let me just quickly show you. Which is now part of our membership. It's a discounted portfolio planning tool, which is called My Finance Future. So you get a 40% discount with that. That's one of the benefits. So My Finance Future Premium Financial Planning Tool. So if you want to do a financial plan in the UK, it's an incredibly powerful app which allows you to do that. And as part of our premium membership, you get that. And of course you get access to me. You can ask a question on chat anytime you like on our chat application. And we've got lots of members only content. And you can do one-to-one with me. Just go to pensioncraft.com/coaching if you want to one-to-one and want to have a chat like this, but just the two of us. So thank you for joining us. Don't panic. Don't sell. Carry on saving. And good luck with your portfolios.